I'm Gord Long with the Financial Repression Authority. I have Ronnie Stoeferle joining us this morning from Vienna. Ronnie is a noted Austrian economist and money manager with Incrementum in Liechtenstein. Welcome, Ronnie.
Hi, Gord. Good to be back on the show.
Oh, how quickly we go. You know, we've been doing updates on your paper that you put out in Gold We Trust now for a couple of years, and I got to tell you, every year the report gets better and better. So I have to flatter you right off the bat on that one.
Thanks a lot, Gord.
And that's
it's getting longer.
Yeah, well, what was the other point? How many pages is it this year?
150 pages.
Okay, so I caution our listeners, I do recommend you download it. It's free. It's on Gold, and it's the most comprehensive outline and paper there is anywhere in the world today. And if it's not in there, it doesn't really exist. But it's put together in a tremendous synthesis fashion that Ronnie and the team at Incrementum do. And again, it's free, no charge to download. Well, that's what we're going to talk about here, is that report. But Ronnie, maybe a lot of our listeners may not be familiar with Incrementum and yourself. Could you just give them a brief outline of things you're involved with?
Sure. Well, Incrementum is a Liechtenstein-based asset manager. We're managing 6 investment funds. We're focusing on what we call Austrian investing. So I'm not only from Austria, I'm also a keen follower of the Austrian School of Economics. From my point of view, we're not in a cyclical crisis, but in a systemic crisis. And the Austrian School of Economics is the only school that really tries to explain the root cause of all the problems that we're having in financial markets, in the economy, but also in society. And one of the main causes is our monetary system, and of course, massive interventions by central banks. So our funds are managed with this background stemming from the Austrian School of Economics. We're writing the Gold We Trust report for 10 years now. I used to work for an Austrian bank before and set it up Incrementum almost 4 years ago. And the bank agreed to continue sponsoring the report. Funnily enough, this year is the first year that they're not sponsoring it anymore, which is perhaps also a good sign, and their timing was brilliant. So yeah, that's what we're basically doing. Last year we published a book called Austrian School for Investors, investing between inflation and deflation.
And that's now available in English, right, Ronnie?
It is, yeah, and we also got a paperback version, new one. We've got a Kindle version, and so on. So it's I think it's a bit more, I would say, theoretical than the In Gold We Trust report. But of course, we're touching gold in the report, in the book as well, and this extremely important interplay between inflation and deflation.
And the book is, and the name of the book again is
Austrian School for Investors.
Right. So it's a much higher level. And between the two, the book and the In Gold We Trust, it's pretty comprehensive reading. And anyone who has any understandings of the Austrian school will really value the book. It's really well done. So, Ronnie, you brought some slides with you to kind of highlight some of the key points that the report is addressed at. And there's just so much, obviously, we can't get into, but I really a dozen slides here to highlight the key points. You want to take us through them?
Sure, absolutely. First, I have to say there's also a compact version of the report for busy readers not having the time to study 150 pages. So there's also a compact version which is just 20 or 25 pages.
And that's available at Incrementum.
Exactly.
And the site's name is Incrementum.
Incrementum.li.
LI standing for
Liechtenstein. Exactly. So, well, we're touching quite a number of different topics in the report. We're writing about inflation, deflation. We're writing about stagflation. We're writing about an impeding recession in the US, but also global recession and the consequences. We're writing about financial repression, of course. We're writing about the consequences, the long-term consequences of low and negative interest rates. We're writing about mining stocks, about the past, the present, and the future of our monetary system. So we're also touching cryptocurrencies, for example. We're writing about mining stocks, etc. So we try to deliver this what we call the holistic view regarding gold. So let's just walk through the highlights of the report. Perhaps the first chart would be the very first chart in the report, where we're showing forecasts regarding gold. 2008, for the first time, I said that gold hits the long-term target of 2,300 US dollars, which is the inflation-adjusted all-time high. So from a technical perspective, in a big secular bull market, the inflation out, and I think that's going to be the same for gold. Can remember in 2000. When gold hit at $1,900, major investment banks was extremely positive regarding gold. So the big banks had price targets between US dollars. And back in the days, everybody told me, Ronnie, your price target on gold is just way too low. You have to to raise it. And I said, no, 2,300 US dollars is fine. Last year, we were ridiculed quite a lot when we long-term target $2,300. But I'm feeling really confident that we're going into this direction. From my point of view, really one of the main points of the report is that we're in a bull market again. Trading like in a bull market, you can tell that from technical aspects, but also from sentiment. We have seen this accumulation phase where really smart hedge fund managers, Soros, Druckenmiller, Dave Einhorn, Carl Icahn, etc., they were buying gold and mining shares already a couple of months ago, and now perhaps we're entering what the Dow theory calls the public participation phase. When media is picking up gold again, when analysts are raising their price targets, when it's getting more mainstream again. Because a couple of months ago, you were really the idiots when you said I'm bullish on gold. So bull market again, and we're gonna enter this public participation phase. 2,300 US dollars is our long-term target, based on the fact that we're expecting rising inflation rates. And the main reason why we're seeing that, of course, excessive over-indebtedness all over the globe. So some people sometimes say that there is deleveraging happening. I just don't see it. So we've got a couple of charts regarding debt development. Japan,
Ronnie, if I could interrupt, if I could interrupt,
Sure.
this is based on obviously U.S. dollars, and
Yeah.
you've denominated. Understand that gold very much varies depending on the currency, obviously, that you're denominating in it. So the question, Ronnie, just is, what's your view out over the next 12 months? Because right now we have a tremendous global slowdown, and the strengthening U.S. dollar, the strong U.S. dollar, has hurt it. Has needs to be devaluing, yen needs to be devalued, etc. But it all on it, they need a cheaper dollar, which would drive the price of gold up if it was in U.S. dollars, if it was a cheaper dollar, dramatically. Comments on any of that?
Sure. Yeah. First of all, the fact that it's confirmed by the numbers. Gold is rising in every currency.
Precisely.
Again. Not just in euro terms, but also in dollar terms. It's doing really well. Canadian dollar, Australian dollar, whatever, Indian rupee, etc. And that's a strong sign for a bull market. What we have seen in the last few years was an enormous US dollar. What was the reason for that? The whole world believed that the Federal Reserve will hike interest rates up to 4 times in 2016. We have seen this ridiculous move by Janet Yellen in December, and we've seen a major sell-off in equity markets in January and February. And now with the Brexit, we will stay lower for longer. From my rule out negative rates in the US, but I think it's obvious that central bankers are really good at finding excuses for not raising rates. And now, of course, it's the Brexit. The Brexit changes everything. I'm sure they would have found other excuses not to raise rates. And of course, they know that our system is that fragile on cheap money, on cheap liquidity. So from my point of view, it's a lose-lose situation that central bankers are in. If they hike rates, they're gonna risk a crashing equity and of course bond market. If they stay lower for longer, the bubble will just bigger and bigger. So the dollar, of course, is the center of it's the world's leading currency, of course. And this dollar strength that we have seen in the last few years, it had enormous consequences, of course, for commodities. There's a very high negative correlation between commodity prices and the US dollar. The same goes for gold. And we have seen major consequences in the emerging markets that are highly dependent on a cheap dollar. So for them, the rising dollar was something like a rate hike. So our advisory board member Jim Rickards already said a couple of times that there has been something like the Shanghai Accord at the G20 meeting in March. So I think the world needs a cheap dollar to reflate the system. We are also writing about the Triffin dilemma. Very, very important topic. I won't go into details, but the world cheap dollar. But everybody wants to weaken its Chinese. So everybody wants a weak currency. Welcome to currency wars. And the question is, against what will they devalue? Probably against gold. I mean, you just have to understand history, and most of the times, if there was a bigger currency reset, fiat currencies devalued against gold. So that makes me pretty confident regarding gold. Regarding the dollar, we said already beginning of last year in our letters to investors that we have seen peak dollar. Everybody was bullish on the dollar. Everybody expected that we are at the beginning of a rate hike cycle. We doubted that, and the dollar looks weak not only against the euro but also against emerging market currencies and so on. So I think we will see a lower dollar. All to say that Brexit is per definition some sort of a deflationary, some pressure on my thesis. I have to is acting much stronger than expected. We're already at the same level almost like before the Brexit. So I think we should prepare and of course for higher gold prices.
Yeah, we're with you on that, Ronnie. Which there's a global shortage. They've got to reduce the dollar. All the currencies, as you say, are in the midst of wanting to reduce, but they've got to get the dollar down and slowing economy. Having said that, it's our opinion long term the dollar will rise, but that's because of a flight to safety and other decreased issues that are looming. But in the shorter term, there's dollar weakness here. But moving to, I didn't mean to get us off track, but it's really important for our listeners to understand it's the denominator currency of pick. But right now, it's rising in every currency, powerful one. But there's an important part of the thinking that needs to go in the charts.
Chart we're seeing what happened for since 2007. We're seeing first of all the leverage ratio of central banks and on the GDP, and you can tell that central banks have gone all in the last couple of years. Of course, the Bank of Japan is like
well, how do you describe it?
The worst. I would find a few German words for that, but it's better not to translate them.
Yeah, that's it. Keep it P. Kuroda, with them leaking that they're really sounds like they're going to helicopter money. Kuroda buying the market. I mean, it's as going to increase the Bank of Japan's balance sheet dramatically.
Sure. I mean, Bernanke was flying over,
yes.
Not with his helicopter, but on a plane probably. We're also reading about helicopter money. I'm absolutely certain that it will be implemented and find a really, really smart and sophisticated abbreviation for that. came out, everybody thought, wow, quantitative easing, that sounds really smart. I think they call it people's QE or central bank. There was also an open letter by European Parliament, members of Parliament to Mr. Draghi, really pushing him to some sort of central bank dividend. So I think everybody who wants to understand helicopter should read Ben Bernanke's latest blog post, and also who is a very, very influential guy. It's called Between Debt and the Devil, and so I'm absolutely certain that they will do something. They do nothing and use a laissez-faire approach that the Austrian school would recommend. So
no matter what they do, it's got to be good for gold.
Yeah, totally agree. And on the next chart, you're seeing that that interest rates have never been as low as nowadays. And I mean, 5,000 years of history, that's quite a lot. And I already said that the longer we stay that low, the more fragile the whole system will become. And of course, we have seen in the last few weeks, we have seen a major move in bond prices. I would say a trend acceleration. We know that a trend acceleration always happens at the end of a big trend. And you've got this negative convexity, really, really scary setup that we're in the middle. On the next chart, you're seeing what we've already said, basically. That of course there's a very, very high interest rates and the US dollar. So we have seen last year that everybody really that the Federal Reserve more hawkish, that the US economy would do really well. I think people underestimate is a problem for the US manufacturing industry, mostly service economy, but it's not sure at the profits in the S&P 500, two-thirds manufacturing sector actually. And of course, a strong dollar has consequences for manufacturing industry. And on the other hand, a strong dollar is also deflationary. And we all know that our centrals want to stop this deflationary trend, and therefore I think that it's not a mandate of the Fed, but the Fed wants a weaker dollar, and this doesn't happen in one day, but I think that's a process, and therefore I think we've seen this topping process in the dollar in the last couple of months, and it coincided of course with the low of the gold price in December, so. We're making a really strong case, first of all, for a recession happening sooner or later in the US. It will have global consequences. From my point of view, a recession is something really normal. It's just like your need for sleep. If you're drowning, espresso or Red Bull later, but it's not going to be really healthy. And the economy needs to cleanse out the system to get rid of misallocations of capital. And the longer recession, due to low interest rates, due to monetary and fiscal stimulus, the worse the recession will get. And we all know if a recession happens, the Fed politicians will definitely act. So that should be really for gold.
You have a well-recognized, well-known inflation signal indicator, and you just mentioned your concerns, what you're seeing going forward. What do you see your indicator telling you right now, as we talk?
We've got the highest allocation to inflation-sensitive assets at the moment.
Okay.
In our main fund, is showing us the strongest signal that we can have in this signal. So it's 100% rising. So it works pretty well. And of course, nobody is really inflationary pressure at the moment. We should forget that starting in July, due to the base effect, and we've also got a very interesting chart on that in the report, just due to the base effect, as we are comparing this year's oil prices with last year's oil prices. And last year, the big down move in oil started in July. So we will have, just due to that, we will have rising inflation rates. But the thing is that it's not only CPI, PCI, and whatever. There's many other inflation indicators showing rising inflation trend. And our inflation signal, we don't care about government statistics, we're caring about what the market is telling us. And gold doing so well since the beginning of the year, silver outperforming gold, mining stocks doing tremendously well, and all commodity sector doing really well. This shows us inflation is going to be a big topic. In fact, we're writing a big chapter about stagflation. Um, Everybody said, you guys are crazy, stagflation cannot happen. Just have a look at the UK. I mean, that's not an unimportant economy. British pound, they will import inflation. Their growth numbers are really going, they're already in stagflation, basically. And I wouldn't rule out that an environment like in the 70s in the US, major stagflation, might be around the corner. This, as you know, is the pain trade for every, let's say, balanced portfolio, 30% equities. They're going to have a hard time in a stagflationary environment.
Yeah, there's no question we have at the consumer level. And forget how they're measured. I know I just talk to so many people, and they roll their eyes. Inflation and things they don't measure. It's like child care payments. When you got two children and both people have to work, they don't measure that. But I'm telling you, telling their budgets. And yes, gas prices are down at the pump, but they're saying that's my interest charges on all my debt payments. So I have little flexibility, and it keeps rolling, and fees and up they're charging, et cetera, et cetera. Property tax, which isn't measured, is going up at a staggering rate in the United States. So these are what people see, but needless to say, it's not. And other than rental rates, they don't really see it in the CPI numbers. Anyway, I got a little off track, but we see the same thing in terms of inflation. And if you're lowering the currencies, therefore paying more on your import, and it's a stated goal. That's what they're trying. Not stated. That's what they're trying to do. That's going to force inflation into the system.
Sure. I mean, I've got one chart in my report showing the admission tickets for in Orlando, and you've got an annual inflation of 9% there.
Right.
So what I'm doing is measuring the admission tickets for Disney World in dollar terms and in gold terms. And I think it's crazy that one ticket is $110. So taking your family out to Disney World for a day, that's quite costly. But measured in gold, it really shows that gold is conserving or preserving your purchasing power. I've been on an ECB board recently, and she said, we don't have any inflation, and that's a problem. And I said, sorry, but we've got massive inflation. We've got monetary inflation. We've got asset price inflation, but we don't have yet the inflation that you want, which is price inflation measured on calculations and hedonics and calculations are. I would question them, and we are already we're also.
Yeah, people don't understand the hedonic substitution, etc. There's a whole bunch of measurements that go in there that are just incredible. That adjusted. So
exactly,
we know that. And imputation, another one.
Exactly, I'm calling it the nominal illusion, and therefore I want to show that different topics like bread, butter, milk measured in gold, they keep rising, but measured in gold, they're not 100% for really long periods. It's just saves your purchasing power.
I would rely on your Disney World, Disneyland ticket as a measure of inflation, and so maybe our listeners should buy gold and pay for their tickets with gold coins when they go down there if they want to go to Disneyland. But anyway, we're getting a little taking you off track here, because we're running out of time here.
I've got the same chart on purchasing power of 1 ounce of gold at the Oktoberfest in Munich.
Yes.
How many liters of beer you can buy with 1 ounce, and that's by far my most popular chart. So
yeah, you've been using that for years. I find it very.
It's a high correlation between beer drinkers and gold bucks, I would say.
Which is a good question. How your beer, your Oktoberfest measure, and your Disney World measure tickets compare? Are they close? Are they the same thing?
No, no. I think for Disney World, one also has to admit that of course the quality got better and it's a huge part compared. On the other hand, you know, the Oktoberfest, a beer is a beer, and the music probably got worse and the food got worse and there are much more tourists, so it's lower than for admission tickets at Disney World. Yeah. But yeah, I think, you know, it's just that's something that people really can understand. Yeah, not like financial up with the really sophisticated indicators, but I really want people to understand the long term use of gold and why it makes just sense to hold gold. But yeah, let's move on. I think there's another interesting chart. It's where I'm comparing the value of gold production versus the volume of ECB and Bank of Japan money creation. And I think it's interesting that Bank of Japan and ECB basically the same amount that roughly 120 billion US dollars, and that compares to the yearly gold production at stable prices.
Is that your measure of the major central banks together in U.S.
No,
dollars?
the eurozone
Just the
and
ECB at 120 billion a month U.S. dollars?
and Bank of Japan, yeah.
And bank, good, because I exactly between the two I can total
Yeah,
that. Yes.
yeah. And then if you compare it to gold, you think, okay, that's scary numbers basically. And then on the next slide we're showing the combined balance sheet of the Swiss National Bank, People's China Bank, Japan in trillion US dollars. And it's sort of weakened in 2012, and now people their balance sheets. And my answer is, you know, just having a look at the history, they they,
They are not reducing their balance sheets. As a matter of fact, their balance sheets are only beginning to grow. Personal opinion.
exactly. So I think gold will catch up, and we're already seeing the beginning of that. Page 11, we're or on the next graph, we're showing our inflation signal. Of course, I cannot give you the exact recipe like Coca-Cola. It's secret, but what we're using, for example, is the gold-silver ratio. Using commodity prices, we are using quite a lot of market-based indicators and also ratios, because ratios in this inflationary world, I think more reliable than nominal, showing massive strength in inflation, and it's basically the firm inflation signal for more than 2 years. And I think, as I've said, inflation, because it just didn't happen the last few years, now everybody's saying it just cannot happen. But inflation, if you study history, it's not a singular event. It's a long process. So I think in the last years, as they did not really manage to get inflation up, and of course there's also massive deflationary pressure in the last few years as central banks just didn't achieve rising inflation. You know, they had to use more. It's like this ketchup bottle harder, and now it seems that it's finally coming up, and that inflation will become an assumption, and what our indicator is telling. And on the next chart, you're seeing something really one of my favorite charts. It's the cycle, so applying it to the gold price, and as if the market is a pain maximizer, I would say, and we have seen, we're also mentioning them in the report, we have seen the most ridiculous articles regarding gold in the last couple of months, and especially at the bottom. There were analysts calling for gold at $300. There was all those arguments saying gold doesn't pay any interest and you cannot eat gold. They all came out the last couple of months, and exactly at the bottom of this bear market. So it's pretty normal that at the bottom of the bear market you're seeing desperation, depression, and so on. And then the market climbs a wall of worries, and this wall at the moment, it seems. So, as I've said, from my point of view, we're at this public participation phase, and of course, then probably in a few years there will be the distribution phase where when smart money will leave gold again. Perhaps it's going to be great value in equity markets then, or perhaps even in bond markets. I don't know, but I think that that shift is happening at the moment.
Ronnie, and just wrapping up here, you mentioned that James Rickards is on your advisory board, and he has just out a new book, Currency Wars Around the World, recognized in all of his activities. But in his book, he's premising the only way out of these currency wars, if they're all massively devaluing together, which doesn't accomplish it, and finally to decide what they want to do is peg their currencies against gold, which will effectively devalue their currencies dramatically together in concert, which I think he premises is probably be at minimum a $6,000 an ounce gold. Way out of this total dilemma. Comments on that?
I agree.
Okay,
I mean,
that's why he's on your board.
yeah. No, I mean we're talking about that with Jim all the time, and you know he's a brilliant man. He understands history. He's really well connected, and he's making this great comparison. In poker, you have to bring some chips to the table, and it's no coincidence that China is massively buying gold. Not only the central bank. We all know that they own much more than those 1,700 tons, but also private people are buying gold. We know that all emerging markets are buying gold at the moment, and we know that the central industrialized nations, they stopped selling their gold. And you know, if you're talking to central bankers, they just don't like talking about gold. They kind of pretend that it's just lying around in the basement in their vaults. But I think there's a good reason why gold is still the main part of the reserve of a central bank, the main backing basically of most currencies. And for example, in the eurozone, the euro system, there are more than 10,000 gold. US still, I haven't seen it, but official owns 8,100 tons of gold. And if you revalue it, there's different calculations which monetary aggregate you want to cover. Of course, that would be a solution, and don't think it's around the corner, but this is going to be on the book basically. I don't know the next chapter to some event, and then rapidly rising inflation rates. I can imagine that. From my point of view, we're already in the early stages of inflation, but one should never rule out a deflationary event. But I think in this huge monetary and global experiment that we're in, it just makes sense to hold gold, and it doesn't have to be 70 or 100. We don't give any exact recommendation. It just depends on your situation and your age. To 20% gold.
Did you include you include silver in that too? Because silver's been actually the better performer.
It is, and in a bull market for gold, silver is going to be in our funds, for example. We're mostly buying silver, and in this 15 to 20%, silver is not included. So I don't know that you have to deal with the volatility of silver, and if you're talking to a really high net worth or ultra high net worth individual, if you want to invest a couple of million silver, just takes a lot of room to handle that. But I totally agree that silver is always starting and is mostly bottoming first, and then silver a couple of months later. We are seeing that the gold silver ratio is falling again, which is a very, very good sign. So,
but falling from historical peaks.
Absolutely. So at around 80, 83, there's mostly the peak in the silver ratio. So that's basically confirming our thesis.
Yep. Ronnie, we have to wrap. There's so much more I'd like to talk about, but we're out of time. Any closing comments you'd like to leave or make with our listeners?
I think that we should prepare for much more government intervention and interventions by central banks, of course. We are seeing that the medicine doesn't work, but they will continue to use more medicine. Um, and I think in this environment you want to hold going. It's probably from a risk reward perspective, it's the best.
Yeah, it's amazing. The medicine doesn't work, they just keep doubling up on it. Be careful. Yeah, right now. Ronnie, we got a break. Could you just tell our listeners again how they could download the report and other information and your book?
Yeah, the report is on our webpage, incrementum.li. Just Google incrementum in gold we trust 2000. As I've said, there's the long version, but there's also the shorter version. Our book is called available on Amazon. Very good reviews. It's been a bestseller, and it won quite on a Chinese, Korean, Spanish translation. So proud that there's so much interest in that. And you can sign up for our research distribution list. It's also totally for free on our webpage. And now we're gonna enjoy it.
Absolutely. I also recommend our listeners explore your signal indicator, your inflation deflation signal indicator. It's a very, very powerful tool. As another reference to track it. And as you're saying, it's at an all-time high right now, which is interesting, telling time. Yes, I'm going to have a great summer. I hope you are too. We're actually friends joining from Austria. Forward to showing them the greater Boston area. So all the best, and we're going to have you back again.
Thank you very much. Good.
Talk to you. Bye.
Take care. Bye-bye.